Hi everyone, welcome to Bond Bytes, the daily bond market highlights from INRBonds. I am Arjun Patsati, and in today's markets, nothing much happening, though equities are moving up and up. The Sensex and Nifty at record highs, even as the 10-year G-sec and the rupee are flat to steady. On other data front, exports and imports jumped year on year. Could be a large base effect as well. And the trade deficit widened, given that the economy is showing signs of economic recovery and higher oil prices globally and for the Indian importers. The government deferred the dues for the telecom company for the next another 4 years, and this has provided relief to equities of telecom stocks. Vodafone Idea stock went up by 25%. But will it help its bonds? The 2-year bond yield is trading at close to 30%, almost at default levels. And though the deferment is there, will it help the company repay its debt? It remains to be seen. And in today's discussion, I'll just highlight the uneasy relationship between the Sensex and the G-sec. As we all know, the Sensex is at record highs and has doubled over the last 1 year from lows seen in the during the COVID, and is trending higher and higher with a huge amount of positive momentum for equities. The momentum has largely been thrust by a two-pronged approach of the central banks and the government. The government has taken up fiscal deficit. It took it up close to 10% last year. And this year, the central government deficit is close to 7%. And the RBI has kept interest rates at record lows of 4% on the repo rate, and is pumping in huge amounts of money. The current liquidity pumped in by the RBI is well over rupees 8 trillion is the system liquidity. The RBI is pumping in money through two ways. One is buying government bonds to keep bond yields from rising and provide support to the government borrowing program, as they have to fund their fiscal deficit through borrowing, and also by buying foreign exchange. So with this, technically, theoretically or intuitively, you could say that with a very high level of government debt and with very largely inflationary policies by the central bank, when the economy recovers and equities are showing very strong signs of very strong economic recovery, there could be high inflation pressures, and this could take interest rates higher. However, when interest rates go up, then equities also tend to take in a bit of rising interest rates in the valuations. But the Sensex and Nifty do not seem to have any hesitation in rising, even as inflationary pressures are looking to be slightly visible definitely. But whether the markets are really considering that the government, very high government debt and very high very loose monetary policy, will lead to interest rates rising going forward. It's not really apparent at this point of time. And so the markets are continuing to live in a very uneasy relationship. The government bond market is worried about inflation, definitely, and it's being held by the RBI at this point of time, the bond yields, while equities are continuing to rise and rise on hopes of more liquidity, cheap rates, and better corporate performance. Trust that work for you. Thank you very much. And please don't forget to subscribe to our YouTube channel if you have not done so already, and visit INRBonds Quick Invest to buy the right bond with the right information at the right price. Thank you for listening in. I'm Arjun Patsati signing off.